One of the biggest challenges when you're shopping for a mortgage or trying to decide what lender to use is how to compare an estimate from one lender to another. Lenders will use different formats for their initial worksheet, but the nice thing is once you actually have a property that you have in mind as far as one that is under contract and you have an application with the lender, lenders have to use the same format. This is helpful because it allows you to compare the exact same sections to the exact same sections. But I'm going to walk you through how to compare estimates if you don't have that same format and if you're just in the initial shopping stages. My name is Rebecca Richardson. I'm the mortgage mentor, and I help hundreds of home buyers every year make smart home buying decisions. So be sure to subscribe and let me know what questions you have in the comments. When you're comparing estimates, there are sections that the lender can affect and the lender choice doesn't affect. The sections that you'll want to pay attention to that the lender choice doesn't affect are going to be things like the title fees. Title fees meaning either what you're paying a title company or a real estate attorney to close the loan. That is going to be their fee, title search fee, as well as title insurance, both for the lender and for yourself. For the most part, that is not going to be affected by the lender choice because it is actually the title company or the real estate attorney that sets those fees. The second thing that you'll want to pay attention to are property taxes. Depending on how your county or state's property tax works, it may be that we can base the tax bill off of the previous tax year. Keep in mind that some counties will automatically trigger a reassessment of a property when a sale occurs. At the point of estimating, we are going to use the taxes that we can see online or give our best estimate based off of the county's property tax rate. Keep in mind that ultimately it is going to be the title company or real estate attorney that is going to designate what taxes need to be collected for that property. So again, that is not affected by your lender choice either. The third thing that is not affected by your lender choice is going to be your homeowner's insurance. That is going to be affected by the homeowner's insurance company that you choose and the coverage that's needed for the home. Again, at the front end, as a lender, we're going to give our best estimate based off of our experience of average insurance rates for the area, but individual details such as claims on the home or personal claims, credit score, or other variables can affect what that policy is going to be, but your lender choice doesn't impact that. The fourth section are going to be escrow reserves, meaning how much needs to be set aside in an escrow account for your property taxes and for your homeowner's insurance. That escrow account will hold those amounts until those bills are due and then paid out of that account each year. The fifth section are going to be recording fees, meaning what does your state and county charge to transfer property from the seller's name into your name. And lastly, per diem interest or daily interest, meaning the day that you close through the end of the month, there will be interest charged on the new loan. So regardless of the lender that you choose, the same amount of days are going to need to be collected depending on if you're closing on the 15th, for example, versus on the 25th. With those out of the way, here are 5 sections you want to pay attention to when you're shopping lenders. The first is going to be the interest rate. And that seems very basic, but the thing I want you to keep in mind is that sometimes you will see even different rates from lender to lender. Ideally, you'll want to be quoted the same interest rate so you can see what the difference in the fees are to make sure that you're comparing side by side. A key point about rates is that rates change daily, sometimes even during the same day. So ideally, you want to make sure that you have an estimate that's been generated on the same day using the same market dynamics and using the same criteria for the loan, things like loan amount, credit score, closing date, things like that. Right next to the interest rate, you are also going to see the APR, the annual percentage rate. And the APR is a good shorthand way to compare what a loan costs to another loan, but I wouldn't base your whole decision on that APR because depending on how a lender has listed fees, that number can be manipulated. That's why it's a good idea to go deeper into the individual criteria. So the first is we have the interest rate and the APR. The second thing you'll want to pay attention to is going to be mortgage insurance. If you have a loan like an FHA loan or a USDA loan or even a VA loan, those mortgage insurance components are going to be the same. If you have a conventional loan, the mortgage insurance can vary slightly lender to lender depending on the contract that they have with the mortgage insurance company. The third thing you'll want to pay attention to are lender fees. If you have an official loan estimate, that's going to be box A. And if you are looking at a closing cost worksheet that's not on that standardized form, you're going to look for things like origination fee, processing fee, underwriting fee, and also discount points. Those first three things are lender fees or lender processing operational costs. With a discount point, you're actually paying additional closing costs to get a lower rate. It's not a bad strategy, but you just need to understand what you're paying for that rate. That's the section that I see that varies the most lender to lender, so you really want to dive in and make sure that you're comparing line item to line item. The fourth section are going to be services you cannot shop for. These are typically going to be things like the appraisal, flood certification, credit report, and other sundry fees that a lender has to pay in order to process a loan. Some lenders do not disclose these and wrap these into their profit margins, which are set by the rate, and then some lenders will disclose them as line items. Lastly, you'll want to pay attention to if there's actually any lender credits for your rate. So just like you can pay discount points or additional closing costs for a lower rate, you can opt for a higher rate that then provides a profit to the lender that the lender passes on to you as a lender credit. It can be very confusing to compare estimates to estimates, but it is worth it to take the time to understand how you're spending your money. I am here to answer any questions you have about this process, about mortgages in general, or just would like a second opinion to make sure that you're getting a good deal. Feel free to reach out to me and my team and let us know how we can help.